In this video, I'm going to go through a problem from Chapter 6 to illustrate how to apply the FIFO, LIFO, and weighted average cost methods, both in the situation where the company uses a periodic inventory system, right here in this problem, and in the situation where the company uses a perpetual inventory system. So for that, we'll do this problem again, but assume that they're using the perpetual system. So it says Cho Sales Corporation uses the periodic inventory system, and it gives us information on how many units are in beginning inventory, their cost, and then a summary of the purchases and sales that were made this year, it looks like, for Cho Sales Corporation. So the first thing you do with any one of these inventory problems is you figure out how many units are sold and how many units are left at the end of the period. So the units sold in this problem, you can quickly see that it's that third column there. We're just going to add up those 400, 1600, and 800. So they sold 2,800 units. And the number of units left at the end of the month, or at the end of the year in this case, for that we need to do the formula beginning inventory plus purchases minus units sold equals the ending inventory. So the beginning were 1,000. Then the purchases we made were 1,800, 800, and 1,400. So beginning plus purchases, this is collectively known as available for sale units. This is the max number of units we could have sold this period. And then of that, we sold the 2,800. So we should have left at the end of the period this calculation. So 1,000 plus 1,800 is 2,800 plus 800 is 3,600 plus 1,400 is 5,000, and then subtract 2,800 from 5,000. So we have 2,200 units left at the end of the period. In this case, the period is a year, as you can see the dates. So at the end of the year, we had this many units left, and during the year, we sold this many units. All right, so we're doing this assuming the company uses a periodic system. And let's first do FIFO. So whether we use FIFO, LIFO, or weighted average, let's summarize. Let's talk about what are we estimating? If you think about the inventory T account, we're given beginning inventory. It's 1,000 times 20. That's given to us. Check mark. We're given the dollar value of the purchases that they made. So that'd be the 22 times 1,800. Let me pull a calculator over here. That'd be the 22 times the 1,800 for that purchase that they made on April 6th, plus the 25 times 800, plus the 28 times 1,400. That's the dollar value of purchases they made this period. Given. What we're not given is the dollar value of their ending inventory. We know they have 2,200 units in ending inventory right here, but we don't know what dollar value we're going to assign to those units. That dollar value depends on what method we use. FIFO, LIFO, or weighted average. So ending, we don't know. Put a question mark. And we also don't know for those units that were sold, these 2,800 units that were sold, we don't know what those units originally cost us. We're going to estimate that. That's the cost of goods sold. That's over here. Depending on what method we use, FIFO, LIFO, or weighted average, we'll get a different estimate for cost of goods sold. So conceptually, this is what we're trying to do. We're given the two things here, and we're trying to estimate this and this using either FIFO, LIFO, or weighted average. So the FIFO assumption is that the first units to come in are the first to be sold. So we can compute an estimate for cost of goods sold first. You can estimate cost of goods sold first. You could also estimate ending inventory first. It doesn't matter which one you do first. But I like to estimate cost of goods sold first and then estimate ending inventory. That's the order that I like to use. So first to come in or first to go out. And we have to keep track of how many actually went out. 2,800. So 2,800 were sold. We assume the first units that were sold were the 1,000 that were sitting there at the beginning of the month. And those were purchased for $20 a unit. So 1,000 of the 2,800 units that were sold, we're going to attach a cost of $20 to those units. We're going to assume those 1,000 that were sold came from the beginning inventory and therefore cost this much. So we're going to assign a cost of goods sold to those units of $20,000. All right. We also sold 1,800 more units. And we're going to assume those came from the next oldest purchases, April 6th. So the next ones we sold during the year were the ones on April 6th, because it's first in, first out assumption. So we sold these 1,800 units, and each of those cost us $22. So you see, that's the 2,800 units. We sold 2,800, and what cost are we assigning to those 2,800? Well, it depends on which ones we assumed we sold. And we're going to assume first in, first out. So we're going to assume the first ones that came in we sold, and then the ones that came in right after that we sold. And those are the 2,800 we sold. In other words, these 800 down here that were purchased on August 9th, and these 1,400 that were purchased on December 30th, we're going to assume we didn't sell those. And if we assumed we sold these 1,000 and then these 1,800, then these are the costs we would attach to those units. So this would be the cost of goods sold if we use the FIFO method. So we can quickly compute here. We have $20,000 plus 1,800 times 22. Keep track of order of operations here. My calculator remembers order of operations. It knows to multiply 1,800 by 22 before adding 20,000. But make sure that you keep track of that, because that can throw off your calculations. So the FIFO COGS, 59,600. Now we estimate ending inventory. What cost are we going to assign right here? What cost are we going to assign to these 2,200 units that are left at the end of the month? Well, it depends on which ones we think are left. If we're assuming in FIFO, first in, first out, so whatever's left at the end of the month must be the most recently purchased units. Well, the ones most recently purchased are December 30th. We purchased 1,400, so we assume that's part of ending inventory. And each of those was purchased for 28 bucks. So we would assign this cost to those 1,400 units that we assume to be left in ending inventory. And then the 800 that were purchased on August 9th are also assumed to be left in ending inventory. And that totals up to 2,200 units. And the ones that were purchased on August 9th were purchased for 25 bucks each. So here are the 2,200 units that we assume are left in ending inventory. The most recent purchased ones at that price, and then the next most recently purchased ones at that price. $1,400 times 28 plus 800 times 25, 59,200. Now let's do the Lifo method. First, we'll estimate COGS. We sold 2,800 units, but now we're assuming last in, first out. So the last ones to come in, the ones at the end of the year, were the first ones to go out. So the 2,800 units we ended up selling this year, we're going to assume 1,400 came from December 30th, 800 came from August 9th, so that totals up to 2,200. And we still sold 600 more units, and 600 came from April 6th. So our LIFO COGS is going to be 1,400 times 28 plus 800 times 25 plus 600 times 22. And notice our LIFO COGS will be bigger than our FIFO COGS. And it should be, because we're attaching, with LIFO, we're attaching the bigger prices to the units that we assumed were sold, because we assumed the last ones were sold first. And when prices are rising over time, that means the bigger prices get attached to the most recently sold units. Whereas under FIFO, we assume the oldest units were sold first in, first out. And if prices are rising over time, that means we're attaching smaller costs to those units that we assumed were sold. And that's why cost of goods sold expense under LIFO will be bigger than under FIFO. So we doing this calculation here, we get 1,400 times 28 plus 800 times 25 plus 600 times 22. Hopefully the order of operations were correct there. So that's 72,400. So I hope my calculator is doing order of operations. I think it is. But if in doubt, if you're ever in doubt, just put parentheses to make sure. So 1,400 times 28, and then close parentheses, plus I can't get to the, so 1,400 times 28, let's start over here, 1,400 times 28 plus 800 times 25 plus 600 times 22. Yeah, so the calculator does know order of operations, but whenever in doubt, just use parentheses to make sure. All right, let's estimate what we think these 2,200 units left at the end of the month are valued using LIFO. Well, if we assume last in, first out, then whatever's left at the end of the month must be the oldest stuff, the stuff purchased furthest in the past. So we would assume the January 1st units are left. So 1,000 of the 2,200 units that are left at the end of the month are from the beginning inventory, we would assume. We would attach that cost to those units. And the other 2,200 units that are left over, the other 1,200 units that are left over, we assume are left over from the April 6th purchases, right? We purchased 1,800 on April 6th. We assumed earlier that 600 of them were sold, and therefore 1,200 of them are left over. Here are the 600 that were sold that we assumed, and there are 1,200 left over. And so LIFO ending inventory would just be $20,000 plus oh, did I mess up? 1,200 times 22, 26,400 plus the $20,000. So yeah, 46,400. And it should be smaller than FIFO ending inventory. And it is. Excuse me. Now let's do the weighted average method. With the weighted average method, if the company uses a periodic system, we compute the weighted average purchase price, which is just the weighted average of all the purchase prices. So if an item of inventory came through our inventory this year, it had to have been purchased for either $20. If it was sitting there at the beginning of the year, it was purchased for $20. It was purchased for $20 last year, that's true. But if it was sitting there at the beginning of the year, it had to have been purchased for $20. Or it was something that came in on April 6th, in which case it was purchased for $22. Or it was something that came in on August 9th, in which case it was purchased for $25. Or it's something that came in on December 30th, in which case it was purchased for $28. So we're computing the weighted average of the $20 price, the $22 price, the $25 price, and the $28 price. And I gave myself space here because a weighted average is nothing more than a bunch of numbers with weights multiplied by the numbers, and then you add everything together. It's the sum product. Weight 1 times number 1 plus weight 2 times number 2 plus weight 3 times number 3 plus weight 4 times number 4. That's an example of a weighted average. Now these weights, what's going to go in the denominator of the weights? The denominator always gets the available for sale units. The max units we could have sold over the whole year. If we're using the periodic system, the denominator of these weights will always be the max units we could have sold over the whole year. And for that, that's this right here. Units in beginning inventory plus all of our purchases, which I think we determined earlier was 5,000. So put 5,000 in the denominator. How many of these 5,000 units were purchased for 20 bucks? 1,000 of them. Those are the ones sitting there at the beginning of the month or the beginning of the year. How many of the 5,000 units were purchased for $22? 1,800 of them. How many were purchased for $25? 800 of them. And then how many were purchased for $28? 1,400 of them. The weights should always add up to 1. By construction, they add up to 1. By the way we constructed it, they have to add up to 1 here. And then we just do that calculation. So 1,000 divided by 5,000 is 0.2. So 0.2 times the $20 price plus 1,800 over 5,000 times the $22 price. That's the same as just 18 divided by 50 times the $22 price. Plus 8 divided by 50 times the $25 price. Plus 14 divided by 50 times the $28 price. So our weighted average purchase price, $23.76. You first compute that. Now we can estimate cost of goods sold, expense, and ending inventory, assuming that any unit we sold or any unit left at the end was purchased for this price. We know that's not true. We know that any unit we sold or any unit left at the end had to have either been purchased for this price, this price, this price, or this price. None of the units were actually purchased for this price, but using the weighted average method, we assume that every unit sold or every unit left at the end was purchased for this price originally. So to compute COGS, we just take the number of units sold times the assumed purchase price, and that's the COGS we would get. And then for ending inventory, we just take the number of units left at the end of the month, or at the end of the period, in this case, the end of the year, 2,200, multiply it by the assumed purchase price, and that's our ending inventory. 2,800, 23.76, 66,528. And then 2,200 times 23.76, 52,272. Now we should verify that the following inequalities hold. For COGS, LIFO COGS should be the biggest, then weighted average, and then FIFO COGS. So let's verify that's true. So our LIFO COGS is 72,400. Our weighted average COGS was 66,528. That is less than the LIFO COGS, so that's good. And then our FIFO COGS was 59,600, which is less than our weighted average COGS. So we can put a check here. We satisfy the inequality. That doesn't mean, though, that we didn't make an error. Just because we satisfy this inequality doesn't mean. So we satisfied it, right? So that means we didn't make an error? No, we still could have made an error. But if we don't satisfy this inequality, then we know for sure we made an error. And then for ending inventory, the LIFO ending inventory should be the smallest. And these inequalities only hold when prices are rising. And costs are rising here, right? From beginning of period to end of period, these same units cost us increasing prices, right? To buy a unit at the beginning of the year was $20. The same unit purchased 4 months later is $22, then $25, then $28. So prices are rising. Then these inequalities hold. If prices are falling, the inequalities are all flipped. All right, so our ending inventory under LIFO, 46,400. Our ending inventory under weighted average, 52,272. And our ending inventory under FIFO was 59,200, the biggest. So at least we satisfy the inequality. It doesn't mean that we didn't make an error, but at least, we satisfy it. All right, let's repeat this problem, but let's assume the company uses a perpetual inventory system, not periodic. So again, first we'll do FIFO. The cool thing about FIFO is that you're going to get the same answers for COGS and ending inventory. You're going to get the same estimates, whether you use perpetual or periodic system. So whatever we computed for FIFO for COGS under the periodic system, 59,600, that's the same thing you're going to get for FIFO COGS under the perpetual system. And whatever we computed for FIFO ending inventory under the periodic system, $59,200, that's the same estimate we're going to get for ending inventory if we use FIFO under the perpetual system. So we're already done with FIFO. Let's move to LIFO. Excuse me. So for LIFO, we're using the perpetual system now. So we can't do everything from the standpoint that we're already at the end of the year like we did under the periodic system. We have to do things sequentially. So as of the standpoint of each sale, starting with February 2nd, we made a sale. We got to figure out the cost of goods we would assign to that sale of 400 units, assuming last in, first out from the perspective of February 2nd. Nothing after February 2nd has happened yet. Only stuff before it has happened. So these 400 units we sold, which units were they? Well, from the perspective of February 2nd, the last ones to come in were the first ones to be sold. So the last ones to come in were the 1,000 that are sitting there at the beginning of the year. So we assume these 400 we sold came from the beginning of year inventory. Each of those cost us $20. So the COGS we would assign to the February 2nd sale is $8,000. Keep in mind that 600 of the 1,000 beginning units are assumed not to be sold. So 600 units from beginning assumed not sold. Keep that in your head. All right, the next sale occurs on July 10th. The COGS we would assign to that sale. So from the perspective of July 10th, we sold 1,600 units, last in, first out. So which ones were sold? Well, the ones most recently that came in were the ones sold. So all 1,600 that we sold on July 10th, we assume came from our April 6th purchases. So this is the COGS that we would assign to the July 10th sale of 1,600 units. And then finally, oh, and keep track. We only grabbed 1,600 of the 1,800 on April 6th because that's all we sold on July 10th. So there's 200 units from the April 6th purchase we assume weren't sold. So 200 units from the April 6th purchase assumed left over, or not sold. All right, and then the final sale we made was on October 23rd. We sold 800 units. And from the perspective of October 23rd, last in, first out, those 800 we sold on October 23rd are assumed to come from our August 9th purchases, the most recently purchased units, the last ones to come in. So we would assign a cost of goods sold of $20,000 to the October 23rd sale. Summing up the cost of goods sold for each of the 3 sales we made this year, we would assign this much total cost of goods sold under the Lifo Perpetual method. Notice the Lifo Perpetual COGS is not the same as Lifo Periodic COGS. Lifo Perpetual COGS 63,200. Lifo Periodic COGS 72,400. In general, they're not the same because it's a different assumption, perpetual versus periodic. Periodic, we get to go as of the end of the year. Everything's already happened. That's what we're assuming. But perpetual, we don't get to go as of the end of the year. We get to go as of the time point of each sale, and then apply LIFO from that standpoint in time, assuming nothing after that time happened. That's why you're going to get different numbers. Now, what about ending inventory LIFO? Ending inventory, there's how many units left at the end of the month? There are 2,200 units, if you recall. It was the first thing we did. We figured out how many units sold, how many units left. There's 2,200 units left at the end of the month. Which units are left over? Well, definitely they're the 600 that were assumed right here, assumed not sold from beginning inventory. Each of those cost us $20 when we bought them. Then there's the 200 left over from the April 6th purchases that we assumed weren't sold. Right? When we calculated the stuff sold here, we assumed these 200 weren't sold, these 600 weren't sold. And the April 6th purchases cost us, what, $20 each? So that's 800 of the 2,200 units that we've accounted for. And then the other 1,400 units that are assumed left at the end of the month must be these December 30th ones we purchased. So 2,200 units left at the end of the month, and these are the costs we would assign to those units. So you would get, for Lifo Perpetual ending inventory, you would get 600 times 20 plus 800 times 22 plus 1,400 times 28. 68,800. Oh, I did this incorrectly, sorry. 600 times 20 plus 200 times 22, not 800 times 22, sorry, plus 1,400 times 28. So 55,600. Notice that Lifo Perpetual ending inventory, 55,600, isn't the same as Lifo periodic ending inventory, 46,400. All right, and then finally, let's move on to the weighted average method. But we're using the perpetual system. So we need to compute a weighted average purchase price. So you see there is a sale on February 2nd between the beginning of the year and our first purchase. So we do need, so our first weighted average purchase price is the weighted average purchase price as of January 1st. And it's just going to be at 20 bucks. Because as of January 1st, there's 1,000 units that we could have sold. There's 1,000 units we could sell as of January 1st, and all of them were purchased for 20 bucks. So our weighted average as of January 1st purchase price is 20. Then we need to compute the weighted average purchase price as of April 6th. Well, as of April 6th, any unit that's come into our inventory or through our inventory, either into our inventory or out of our inventory, well, into our inventory, was purchased either for 20 bucks or 22 bucks. So as of April 6th, we're computing the weighted average of 20 and 22. How many units are available for sale? The denominators of these two weights. How many units are available for sale as of April 6th? There were 1,000 at the beginning. Then we sold 400, so that we have 600 left as of February 2nd. But then on April 6th, we purchased an additional 2,800. So there's 2,400 units at maximum that we could sell as of April 6th. How many of the 2,400 were purchased for 22 bucks? 1,800 of them on April 6th. And the other 600 are assumed to be left over from the beginning inventory, and they were purchased for 20 bucks. All right, next let's compute the weighted average purchase price as of August 9th, the next purchase date. So as of August 9th, any unit that's come into our inventory was purchased for either 20 or 22 or 25. But we already have the weighted average of 20 and 22 calculated by this calculation. So we need to compute that first. So 6 divided by 24 is a quarter. And then 18 divided by 24 is 3/4. Sorry, let me go back here. So as of April 6th, our weighted average purchase price is 21.5. So as of August 9th, so I said April here. As of August 9th, any item that's come into our inventory was purchased for either 20, 22, or 25, but the weighted average of 20 and 22 is 21.5. So we're going to assume any item that's come into our inventory from the beginning of the year to August 9th was purchased for either 21.5, not 75, I don't know why I wrote that. It was either purchased for 21.5 or it was purchased for 25. How many items as of August 9th could we sell at max? Well, as of April 6th, the number of units we could sell was 2,400. We determined that earlier, right here. So what happened between April 6th and August 9th? Well, what happened was we sold 1,600 units. So 2,400 minus 1,600. So as of July 10th, there are 800 units that we could sell. But then we purchased 800 on August 9th. So as of August 9th, there is 1,600 units at max that we could sell. How many of those 1,600 were purchased for 25 bucks? 800 of them. And the other 800 are assumed to have been purchased for 21.5, which is the weighted average of 20 and 22. So let's compute this. So we got 0.5 times 21.5 plus 0.5 times 25, and we get 23.25. And then finally, we need to compute the weighted average purchase price as of December 30th, the last purchase date. So as of December 30th, not 31st. Sorry for the little typos here, but at least I'm correcting them as we go. As of December 30th, any item that's come through our inventory, we're going to assume was purchased for either this price, which is the weighted average of the 3 previous prices, or it was purchased for the $28 on December 30th. So we're computing the weighted average of the 23.25 and the 28. As of December 30th, how many units could we sell at max? That's what goes in the denominator of these two weights. Well, as of August 9th, we determined at max we could sell 1,600 units. So what happened between August 9th and December 30th? We just sold 800 of them. That's the only thing that happened. And then we bought 1,400 more. So 1,600 minus 800 is 800 plus 1,400. So there's 2,200 units at the end of the year we could sell, which is our ending inventory, of course. How many of the 2,200 were purchased for $28? 1,400 of them, leaving 800 that we assume were purchased for the weighted average of those 3 previous prices. So 8 divided by 22 times 23.25. Whoops, didn't mean to hit equals. Plus 14 divided by 22 times 28. Move this over so you can see. So 26.27 repeating. So our 4 weighted average purchase prices are this number, this number, this number, and this number. And once you get those numbers correct, then the rest of the problem will be correct. But if you get any one of those numbers wrong, for example, suppose you got this number wrong. Well, this number is used right here in the calculation of this number, which means this number will be wrong, which means this number will be wrong. So you have to make sure you get these weighted average purchase prices all correct. And if you do that, then there's a very high chance that you will get the problem right. You could still make an error after this, but it's not likely. I just want to verify again. I want to verify again that this number is right. So 8 divided by 16 is, so what? This is 0.5 times 21.5 plus 0.5 times 25. So that number is right. Let me verify that this one's right again. So this is 8 over 22 same as 800 over 2200, times the 23.25 number, plus 14 over 22 times 28. 26.27, okay. So I'm confident that the WOPs are all correct. You got to be confident of that, otherwise you're just going to use the wrong numbers and everything's going to be wrong. So now we can compute the cost of goods sold under the weighted average method. But again, as we did with LIFO, since we're using the perpetual system, we have to go sale by sale. So first, the February 2nd sale. Those 400 we sold on February 2nd, we assume were purchased for the most recent weighted average purchase price. So as of February 2nd, the most recent one we've computed looking back in time was this one, on January 1st. So these 400 units that we sold on February 2nd, we assume we purchased for 20 bucks. So we would assign $8,000 cost of goods sold to those. All right, what about the 1,600 units we sold on July 10th? We assume, from the perspective of July 10th, what's the most recent weighted average purchase price? It's this one on April 6th. So we assume all 1,600 units that we sold on July 10th were purchased for $21.50. What about the 800 we sold on October 23rd? What COGS would we assign to those units? Well, as of October 23rd, what's the most recent weighted average purchase price? It's this one. So we would assign this, we would assume that each of these 800 we sold on October 23rd were purchased for $23.25 when we originally bought them. So we would assign this cost to those units. And then that's it. Those are all the sales. So we sum those numbers up, and that's our total cost of goods sold weighted average perpetual. $61,000. What about ending inventory under weighted average perpetual? Well, we know there are 2,200 units left at the end of the year. And from the standpoint of the end of the year, what's the most recent weighted average purchase price? It's the one computed on December 30th, which is one day back in time from the end of the year. So we assume each of these 2,200 left at the end of the year were purchased for $26.27 repeating. So here I'm going to have to round to the nearest whole dollar. So $57,800. Oops. All right, as we did with the periodic way, we checked that these inequalities hold. Those same inequalities should hold with the perpetual way. So first for COGS, our LIFO COGS should be greater than our FIFO, should be greater than our weighted average, which should be greater than our FIFO. So our LIFO COGS is 63,200. Our weighted average COGS is 61,000. And our FIFO COGS was 59,600. So at least the inequality holds there. That's good. It doesn't mean, though, that we didn't make an error. But at least if this inequality didn't hold, we know for sure we made an error. And that would give us an indication that we need to go back and recalculate something. And then for ending inventory, our LIFO ending inventory should be the smallest of the three. So 55,600, that's the LIFO ending inventory. That's smaller than the weighted average ending inventory that we calculated just a minute ago, 57,800. And that's smaller than the FIFO ending inventory of 59,200. So we satisfied the inequalities. Again, that doesn't mean we didn't make an error, but it gives us an indication that we're on the right track. And that concludes this video.